Hi, my name is JSimpson. I'm here to talk to you about composites with respect to GIPS compliance. So composite is essentially a group of accounts that follow a given investment strategy, objective, or mandate, or in the case of a closed-end real estate fund or a closed-end private equity fund, you would also define composites by vintage year. So it would then be vintage year plus investment objective, strategy, or mandate. So really a composite then is the core concept of the GIPS standards. When a firm claims compliance with GIPS or establishes its compliance with GIPS, we say there's three big steps to that process. One is the firm definition, which really defines how the firm holds itself out to prospective clients. Two is the definition of discretion, i.e. what accounts at that firm does the firm have the ability to implement its strategy over. And then three would be the definition of composites. So composites then are how the firm holds its strategies out to the marketplace, to prospective clients. Having said that, then, the firm has a lot of leeway with respect to defining composites. An important part of establishing compliance with GIPS is documenting your policies and procedures, and an important piece of that is your definition of composites, which clearly delineate the criteria that you use to segregate accounts into different composites. So you can have accounts that follow a given strategy, for example, that use leverage, and accounts that don't. So that is an optional criterion. Other things that you could use as a criterion would be use of different benchmarks, tracking different risk statistics, following restrictions for a given account. All those things the firm can choose whether they want to include the accounts in the composite and have a more broadly defined composite, or to have a narrowly defined composite. Now, having said that, all actual fee-paying discretionary accounts must be reflected in the firm's composites. So when the firm defines composites, it needs to go through and make sure that every account that's actual, fee-paying, and discretionary is included somewhere. Every account that is discretionary then must be included in a composite, and the composites must always reflect a specific strategy. So there's no, the firm cannot have miscellaneous composites. So having said that, then the composite is the key piece for GIPS compliance, the presentation that the firm is making of its performance. And that presentation shows certain key elements, such as the returns for that composite, the amount of assets in the composite and the size of that composite relative to the firm assets, the number of portfolios, the internal dispersion of the composite, and also then disclosures about the composite and about the firm to help the reader of the presentation understand how the firm deals with that strategy and how the firm has been performing with respect to that strategy. So a couple of key guidance statements to be aware of. There is a guidance statement on the definition of the firm, which would help the firm with that first big step in the process, firm definition, and also the composite, the guidance statement on composite definition, which includes a section on the definition of discretion. So that would give you some of the information about what you can consider and what you must follow. Again, the key thing is that your composites must be defined by strategy, objective, or mandate, plus vintage year in the case of closed-end real estate or private equity. So those are some of the important points to understand with respect to composites. Again, keep in mind your composite definition is a key part of that documentation. Also your composite description, which appears in the presentation. It's important to make sure that that is, has all the salient aspects of the composite for the reader of the presentation to understand. And with that, I hope this has been helpful for you to understand composites and their importance with respect to the GIPS standards. Thank you.